Let's come to the next topic, that is the accounting equation. Now, what is the meaning of accounting equation? An equation simply says that, for example, when I say 5 plus 2, obviously it will be equal to how much? 7. So this is an equation where your LHS is always equal to your RHS. Is that clear? So in accounts also, the LHS is always equal to RHS simply means that all the assets are equal to all the liabilities. Okay? So in accounting, it simply means that all the assets are equal to all the liabilities. Okay? Now what does that mean? Let me explain you. So is it like that if we own a house, we will have a liability for that? Or else if we have a car, we have a liability for that as well? How is it possible that if we have some property with us, we have an equal liability for that? That simply means that if we own a car for rupees say 5 lakhs, we also have a loan, we also have an amount to be paid to someone for 5 lakhs. How is it possible? It is just possible, for example, if you have purchased this car for rupees say 5 lakhs and you have not paid the cash immediately. You have not paid the cash, but you have purchased this car on credit. Since you have purchased this car on credit, so what will happen is the car which you have will also have a liability that you have to pay back the amount to that person from whom you have purchased that particular car. Is that clear? So this is why the assets are always equal to the liabilities when you purchase it on the credit. Okay, let's just read out the explanation part, then I'll explain you with one more example. Okay, so accounting equation signifies that assets of the business are always equal to the total of its liabilities. As I just told you that all the assets, the total of all the assets will be equal to the total of all the liabilities. Now, and capital, that is owner's equity, the equation reads as follows, that is A is equal to L plus C, that is A is equal to L plus C, where A is known as the assets and L is basically your liability and C is basically your capital. Okay, this is the main accounting equation which we have to study, which we have to deal with. Now it says the above equation can also be presented in following forms as its derivatives to enable the determination of missing figures of capital or liabilities. That simply means if at all we don't have the liability, we only have the assets and capital, we can find out the liability only. Or can't we find out the liability? We can always find out the liability if we have two of the items. That is, if assets is known to us, if assets are known to us, what we will do, we will simply take this capital on the LHS side, so it will be of minus in nature. So after deducting capital from the assets, you will get the amount of liability and so on. So this is also possible if you don't have one item, then you can find out that item by subtracting or adding the other two items. Okay, this is accounting equation. Now, what happens? Let's check the next slide, then I'll come back to the answer. Now, as we just did that, when we deducted liabilities from the asset, we were able to find out the capital. When we deducted the capital from the assets, we are able to find out the liabilities. It is simply that because these two items are equal, that is, assets is always equal to liabilities plus capital. If you want to know what is the amount of liability, you will simply deduct capital from the assets and you will get the liability. If you want to know the capital, simply you will deduct from the assets the liabilities and you will get to know the capital. So this is the derivative part of this accounting equation. But the main accounting equation is simply the assets are always equal to liabilities plus capital. Then only we will be able to find out these two types of missing figures. Okay. Next, the accounting equation depicts the fundamental relationship among the components of balance sheet called the balance sheet equation. Obviously, the balance sheet has two of the items, that is assets and the liabilities. So balance sheet has two items and balance sheet is that's why known as the position statement. Balance sheet is known as the position statement because the balance sheet shows two of the main items which are there in the business. Namely, the first one is the assets, the second are the liabilities. Okay, so that's why it is perfect for the accounting equation as all the liabilities are equal to all the assets, and this is only stated in the balance sheet as well. Now the question arises, we are here seeing that assets is equal to liability plus capital, but we have already learned that capital is also a liability which a owner has to get from the business. That is, the business owes this amount to the owner. Since we have already studied that there is a separate legal entity. Separate legal entity simply says the owner and the business are two different persons. Since these are two different persons, so these are two separate entities as per the law. So when a businessman, when an owner starts a business, he invests the amount into the business. For example, if you are in a need of money, obviously you will go to your friend or else you will go to the bank and ask for the loan. Okay, the bank is another entity and you are another entity. So basically the bank is giving you the loan. Since they are giving you the loan, it is a liability for you that you have to pay back this actual amount. Same goes with business as well. When an owner starts a business, owner invests the amount into the business. So this amount is a liability for this business. So liability in short are of two types. The first one is the internal liability. The second one is known as the external liability. Now the question arises, what is the meaning of internal and external? As the name suggests, internal liabilities is the amount of liability which a business owes to the internal persons. Now the question arises, who are internal persons? So the internal persons are basically the owners. So the amount owed by the business to the owner in the form of capital is known as the internal liability. Okay. Apart from that, the amount owed by the business to the external persons, to the outsiders, is known as the external liability. That is basically, for example, if you are in a need of a loan, so you will go to the bank, you will take a loan from the bank. So it is a liability which has to be paid back to the bank. Next, apart from that, suppose you don't have the goods, you don't have the cash to buy the goods. Obviously, you will go to the suppliers and ask for the goods for which the payment will be done after a period of time. So this is also a liability where we have purchased the goods on credit. Exactly. So external liabilities are the liabilities which are concerning the outsiders. That can be the bank from whom we have taken the bank loan. Apart from that, the creditors from whom we have purchased the goods on credit. So these are basically two types of external liabilities. Okay, so that's why the formula is assets is equal to liability plus capital. So liability, here liability simply means the external liability. Is that clear? Just don't get confused with the internal and external. It is simply when in the accounting equation liability is written, it simply means the external liability only. And obviously we have one more thing, one more name, that is the capital. So capital is basically the internal liability. Now just imagine you are the owner of the business. So usually you are the owner, you are running the business, you have invested the amount, you are doing each and everything to make the profit out of your business. Okay. So it is simply said that this is a liability, but because it's an internal liability, so it is not considered under the liability section, but it has been, bifurcated into two parts: the liabilities and the capital, the external liability and the internal liability, which is known as the capital, in simple words. I hope this much is very much clear, that all the assets are always equal to liabilities. That is, all the assets are always equal to internal and external liabilities. That is, all assets are equal to the liability and the capital. Okay. So next, as the name suggests, balance sheet is a statement of assets and liabilities and capital. Obviously, as we just saw that in the position statement in the balance sheet, that is the balances. It is the balances of all the statements of assets and all the liabilities. Since we have four pillars in accountancy. Now, what are the four pillars? Four pillars are basically the first one is the four pillars in accountancy. The first one is the incomes. Second one are the expenses. Third is your assets. And the last are your liabilities. These are the main four pillars in accounting. Just remember, you will encounter these four words throughout the journey of your accounting. Okay. From income, when you deduct expenses, you get the profit. Now, this profit is calculated in a statement which is known as profit and loss account. The profit and loss account is prepared where all the incomes are noted down and all the expenses are noted down. After adding up all the incomes, you deduct the sum of all the expenses in order to get the profit. Likewise, when you have all the assets and liabilities, these are recorded in the balance sheet, where the sum total of assets is always equal to the sum total of liabilities. Now, again, the question arises, how is it possible that suppose we own a car and suppose we own the factory which was purchased by giving the cash? How is it a liability also? Why is it so that the amount of assets are always equal to liabilities? That simply means for everything we have a liability. That means we owe this amount to someone which we have to pay in future. Why is it so? Let me just explain this, a small concept. When we start a business, what happens? There is a person who is the owner of the business. Okay. Now just imagine the scenario of a business. In a business, when a business gets started, owner puts in the capital. What happens? Business gets two of the items simultaneously. As we have already studied the dual aspect, the double entry system. So the business gets two of the items immediately. The first one is the asset and the second one is the liability. So in the form of asset, what do we get? We get the cash, because the owner invests the cash into the business. For example, we have got 10 lakhs as the cash, and in liabilities, we have got also a capital of 10 lakhs. With this, you can see that these both have become equal from the first transaction itself. Now let's check the other transactions and see whether the transaction which we are doing on a daily basis will affect the asset and liabilities, and will the remaining outcome, that is the total of assets, will it be equal to total liabilities or not? Just check it out. Now we have started a business with rupees 10 lakhs. So we have a cash of rupees 10 lakhs and we also have a liability with the name capital of 10 lakhs. Okay. Next. Now, since this is a business, so obviously the amount is liable to the owner. As I already told you, these two persons are totally different. These are two separate entities. Now, Suppose we purchased a machinery for rupees 3 lakhs. Just imagine we are purchasing a machinery. Okay. So machinery, when you buy a machinery, when you purchase a machinery, obviously the machinery will come to you and you will have to pay the amount to the concerned person. So basically what's happening, you are purchasing the machinery is coming to you and the cash is going out. Machinery again is an asset. So since machinery is an asset, so what will happen on the asset side? The cash will reduce. I'm just cutting this off. Why? Because now I will remain with only 7 lakhs as cash. Obviously, I had 10 lakhs rupees worth of cash with me, of which I have purchased the machinery for 1, 2, 3, 3 lakhs. So now the remaining cash will be 5 plus 2, 7. Is that clear? So the cash in hand, I will have a cash of rupees 7 lakhs in my hand. Apart from that, I'll also have a machinery. Okay, now I will have a machinery for rupees 3 lakhs. Now since I have a machinery of 3 lakhs, so the total of my asset becomes 7 plus 3, 10, which is equal to the liability of a capital of rupees 10 lakhs. Now the question arises, since we have purchased this machinery by giving the cash, okay, so this simply means we have a machinery of 3 lakhs. We also have a liability to be paid to the other person. Yes, we do have a liability. What type of liability? It is a liability with the name capital, because this 10 lakhs was given by the owner. Just understand this. This 10 lakhs was given us by the owner. So the business owes this amount to the owner. Okay. This full 10 lakhs is of the owner. Okay. Now, from this 10 lakhs only, what did the business do? I'm not doing. Business is purchasing. So for the business, there is a machinery which is coming in. So machinery, we have a machinery worth of rupees 3 lakhs. Apart from that, we had 10 lakhs in cash in hand. Now, since we have purchased the machinery, we have paid the cash. So what will be the remaining amount? The remaining amount is rupees how much? 7 lakhs. Now we have 7 lakhs worth of cash in our hand and a machinery worth of 3 lakhs. So the total of these is what? 10 lakhs. And this is the only amount which a firm, which a business owes to the owner. So that's why this machinery of 3 lakhs has a liability also. It is not for the external person, it is for the internal person only, because he had only given us the cash of rupees 10 lakhs. Now, for example, we purchased a building. Okay, we purchased a building for rupees say 5 lakhs. We thought we should have the cash with us for purchasing the building. What did we do? We went to the bank. We asked the bank if you can give us 5 lakhs so that we can purchase the building. Okay, so the bank agreed and gave us a loan of 5 lakhs. Is that clear? Now what will be the scenario? In your liability, there will be another item with the name bank loan. So bank loan will appear with rupees 5 lakhs. Okay, and in the asset we will have a building. So in the asset we got a building for rupees 5 lakhs. Now what's happening? Now the thing is, in total we have 15 lakhs worth of assets, 7 lakhs worth of cash, 3 lakhs of machinery, 5 lakhs of building. In total we have a asset of how much? 15 lakhs. For the same assets, for the same amount of assets, we do also have a liability also of how much? The same 15 lakhs, of which 10 lakhs is owed to the owner, that is the internal liability, and apart from that 5 lakh is owed to the external person. Just imagine, we didn't pay any cash for buying the building. We just took a loan from the bank, and the amount which we have taken from the bank was straight away given to the supplier of that building. So the person got the amount directly from the bank and we got the building. So we have the building with us, and also the liability, that is bank loan, with us. Is that clear? So this full 15 lakhs is owed by the business to two of the person. One, the external liability, that is the bank loan, 5 lakhs. Second is basically the capital, that is rupees 10 lakhs. I hope this is now very much clear to you that for all the assets we have a liability. So just be informed that we are not talking about us. I'm not talking about me as an owner, but I am talking about the business. Just whenever you record the transaction, whenever you imagine the transaction, just don't think that you as a person are doing things. No, you are doing nothing. Your business is doing. Your business is purchasing an asset in the name of business, not in the name of owner. Is that okay? So that's why when you will see through the eyes of the business, so the business already had a liability, of capital worth of rupees 10 lakhs. So obviously the asset which we have rupees 10 lakhs is a liability also, because this is the amount which we have to pay back to whom? To the owner. And if we are purchasing a machinery out of that cash, again that also has a liability of what? Of the capital itself. So that's why always the assets are always equal to the liabilities. Okay, just don't get panicked that all the assets have a liability. Yes, because this amount was given by the owner to the business. Initially only the capital was a liability. So obviously each and every item you purchase from this cash will also have a liability of capital only. Let me take another example. If I purchase a furniture for rupees 2 lakhs, now I will get the furniture. I will have a furniture with me of rupees 2 lakhs. Obviously, in order to buy the furniture, in order to purchase the furniture, I will have to pay the cash. So I have a cash of how much? 7 lakhs. If I pay 2 lakhs for purchasing the furniture, what will be the net amount left with me as a cash? Obviously 5 lakhs. I had 7 lakhs, of which I paid these 2 lakhs for purchasing the furniture. What is the net amount I have remaining in my hand? That is the cash, only 5 lakhs. So 5 lakhs will be remaining as a cash in my hand. So my cash is reducing. Just imagine one thing, my cash is reducing, and for exchange of the cash, I am getting different type of assets. Now, I had 10 lakhs. Just imagine a bag full of 10 lakhs. This you have taken from the owner just to do the business. So if you pay back this amount immediately to the owner, you will shut down your business. Why have you taken the loan? Why have you taken the amount from the owner? Because you have to do the business. You have to start doing the transaction so that you can earn profit. Now you have 10 lakhs worth of rupees that you owe, you as a business owe this amount to the owner. Okay. Now since you owe this 10 lakhs to the owner, so if you spend 2 lakhs and you get furniture, so as a whole, what is the amount of assets do you have? You have 8 lakhs worth of cash and 2 lakhs worth of furniture. Again, you purchase machinery for 3 lakhs. So again, you spend 3 lakhs and you got the machinery. So what is the total amount of assets do you have? You have cash worth of 5 lakhs, and apart from that, you have furniture of 2 lakhs and machinery of 3 lakhs. In total, the assets are of how much? 10 lakhs. This whole amount was given to you by whom? The owner. So that's why the cash of 5 lakhs and the amount you spent on purchasing the furniture and machinery is also have the liability. What is the type of liability? The internal liability, that is the capital. That's the beauty of the balance sheet, that all the assets will always be equal to the liabilities plus capital, because initially the business started with the liability only. Business didn't have its own funds. It borrowed it from the owner. So owner is the other person and the business is other person. Is that clear? Now next is, so point of time, resources business entity equal claims that of those who have finance resources. Obviously that all the items in the balance sheet are equal, as we all know. So it depends upon the actual date. On that particular date, all the assets will be equal to all the liabilities. Now, as of now, we have liabilities worth of how much? 15 lakhs. And we also have an asset of worth how much? 5 plus 2, 7 plus 3, 10 plus 5, 15 lakhs. So in total, we have 15 lakhs worth of resources and 15 lakhs worth of liabilities, which is to be paid back to the external and internal liabilities. Okay. So it is at the time, at a point of time, we can see that always these are equal with different transactions that will always be equal, as I just made you write down this. Okay, next. So proprietors and outside provide the resources of business. Obviously, now we can see this is the amount given by whom? This is the amount given by the owner, who is also known as the proprietor. And we also have the amount of liability, that is external liability, in the form of bank loan, which has been provided to us by the outsider. That has been written, the proprietors, this is the internal liability, proprietor owner's fund, and the outsiders, this is the outside liability. They both provide the resources for the business. They both have provided the cash to do the transaction, to start the business, to spend the money, and to get the assets out of that. So this was the full explanation of accounting equation. Next, accounting equation says claims proprietors is called capital and outside is liabilities. As we just saw this is what we saw, that liabilities are of two types. First is the capital, and the second one is the liability itself. So just to make you understand, they have just written the amount the business owes to the proprietor, that is the business owner, is known as capital, and the liabilities which are owed to the external persons, or the outsiders, are known basically the liabilities. So liability simply means the amount which a business owes to the external person, and the amount which is owed to the owner or the proprietor is known as the capital, that is the internal liability. Okay, next. So element of the accounting equation is the part of balance sheet. Obviously, we just saw balance sheet has two of the items, assets and liabilities. So accounting equation is derived from that balance sheet itself, which says that all the assets will always be equal to liabilities and the capital itself. Okay, next, which states the financial position of business on particular date. Just remember this one very much important point, that okay, what happens, there is a concept known as accounting period concept. Okay, accounting period concept simply says that the financial statements which are prepared by the business, by the organization, should be of a particular period. Now, what is that particular period? That period is of 1 year. This simply means that all the transactions which are concerning to that particular 1 year's period, should be noted down. Then only you will be able to find out the actual profit. So suppose that 1 year begins from 1st April 2023 and it ended on 31st March 2024. Okay, this is the time period of which we are making the financial statements. Now, when we are making the financial statements, and one more thing, in accounting, our year starts from 1st April. You should know this, that our year starts from 1st April. You know what happens? Outside India, there are many countries who follow the date, their calendar, which starts from 1st January, 31st December. But as per India, as it is concerned to India, the Hindu calendar is, taken preferably. That simply starts from the new year of Hindus, start from 1st April. And since our India is an agricultural country, so our main purpose, our main occupation is to grow the foods. So the new process of growing the food, growing the plants starts from the harvesting. Each and everything starts from mainly from the April. That's why our accounting year starts from April itself and it ends on next year's 31st March. Okay. So be informed that accounting period starts from 1st April and it ends on 31st March. So it's a period of 12 months. Okay. Next. Now, all the incomes of this period have to be recorded in the financial statements, and then all the expenses are to be deducted from these particular incomes only, which are of that 1 year's period of time. Okay. So for the full year, we calculate the profits. Okay. So the profit and loss account is prepared for a full year, which has all the incomes and expenses for that particular period. But the balance sheet, the position statement is made on a particular date. It is not for a period, but it is for a particular date. I just repeat what I just said. I said that the financial statements, which simply means the preparation of profit and loss account. Profit and loss account is prepared in order to ascertain whether we have earned profit or we have incurred loss. We have to make profit and loss account where all the incomes and expenses are to be recorded. Now, since we have recorded all the expenses and all the incomes, we will get the info that we will get the profit as a whole. It is for a period of time, that is for 1 year. But the balance sheet is prepared on 31st March and all the assets as on that date are recorded and all the liabilities as on this date is also recorded. So all the assets and all the liabilities as on this date is to be recorded. Okay. It is never for a period of time, because in a period of time you must have purchased, you must have sold, you must have gathered, you must have whatever you have done, depending upon the usage of your assets, you must have purchased and sold the assets. But the balance sheet is only concerned with the actual date, that is on that date what is the actual scenario, what amount of assets do we have and what amount of liabilities do we have. That has been written, that a position statement which states the financial position of business on a particular date, it is to be made on a particular date only. For example, if I make my balance sheet on 1st July 2024, so the assets as on that date will be recorded and liabilities as on that date will be recorded. It doesn't works with the criteria of accounting period. It is just made on that particular date. Is that clear? Okay. So we have to analyze the transactions, then only we have to record it in the accounting equations. Next, asset side of the balance sheet is the list of assets which the business entity owns. Obviously, assets are the items which a business owns, from which the future benefits, the benefits we will get will be for more than 1 year. So these are basically the assets, the list of assets we have on that particular date. Apart from that, the liabilities side of the balance sheet is the list of owner's claims. Owner's claims simply means the capital. The capital is also a liability, as you all know. Capital, that is the owner's claims, and outsiders' claims, that is your external liability. So liability will have two of the liabilities, internal and external. Internal simply means the capital, which is owed to the owner. Second is the outsiders liability, which the business owes to the outside persons. Okay. So what the business entity owes, obviously the amount which is owed by the business to the external or internal persons. So this was the brief of the accounting equation. I hope this is very much clear to you all. Okay, now next, coming to the next slide, the equality of asset side and liability side of the balance sheet is undeniable. Now, what does that mean? Obviously, with all the transactions, the assets and the liabilities will be equal. That is undeniable, that always, it will always be equal. You can do each and any transaction you do, always it will be equal. Is that clear? Next, facts and justifies name of accounting equation as balance sheet equation. Obviously, since this accounting equation is derived from the balance sheet itself, so it is also known as the balance sheet equation because there the assets and liabilities are always equal. Next, for example, Rohit started business with a capital of rupees 5 lakhs. From the accounting point of view, the resources business entity form has a cash of how much? 5 lakhs, and the source of this is basically a capital of rupees how much? 5 lakhs. As we just saw the example in the previous slide, that when we started the business with rupees 10 lakhs, so the asset side was showing a cash of rupees 10 lakhs, and the liabilities side was showing a capital of 10 lakhs. So that has been written here, that Mr. Rohit, there is a person Rohit, who has started his own business. Now, when he has started the business, he has given the cash of rupees 5 lakhs to start the business. Since these two are different persons, the business will have assets and will also have a liability. So in the form of asset, the business will get cash worth of rupees 5 lakhs. Apart from that, a liability worth of rupees how much? 5 lakhs of capital. So, so basically, the resource, what is the resource which a business is getting? It is getting the cash. What is the cash? Cash is basically the resource. We have resources, we have assets, we have items. These are what? Resources, assets only. Okay, and the sources of this cash, from where did we get that cash, is basically the capital. Now, who has given the capital? Mr. Rohit has contributed the capital with of rupees how much? 5 lakhs. Is that okay? So always it will be equal. So capital is basically the source of the cash, from where we got the cash, and cash as an item is a resource from which we can do each and everything. We can purchase assets, we can purchase goods, we can pay salaries, we can do each and everything in order to earn the profit, in order to run the business. Okay, next. Okay, now let's see this. I think this much is very much clear to you. If it is very much clear to you, now let's see this presentation. Now, put this information in form of equality of resources and sources. Obviously, this simply says, this puts the information in the form of equality of resources and sources. Resources, the assets we do have. Okay, basically resources are assets and sources are the liabilities. Okay, for example, if you want to buy a building, you had to buy a building. What did you do? You went to the bank, you asked for the loan, you got the loan, and you purchased the building. So building is a resource from which will be useful for you, and the bank loan is a source of money from where you got the money. Is that clear? So that's why it is the equation which involves sources and resources, where these both are always equal. Okay, now let's see this. Let's see this. In the books of Rohit, we are able to see the balance sheet. So we are able to see the balance sheet. Balance sheet simply has the liabilities and the assets. Since it has the liabilities and the assets, so in the assets we have cash in hand of rupees 5 lakhs and capital worth of rupees again 5 lakhs. And after doing the total, we have got 5 lakhs is equal to 5 lakhs. These both are equal as per the accounting equation. as per the format of the balance sheet. Okay, this is the actual presentation. This is how we present this in the balance sheet. Okay, the format of your accounting equation is a bit different, but looking into the balance sheet, the format is like this: the liabilities first, and the side one is the assets. Next, now in accounting equation, we have a balance sheet where total assets are equal to total liabilities of the business. Since business started to do the activities, why do we start a business? We simply start a business to do the activities and earn the profit out of the amount invested in the business. Okay, now let's read it once again. Balance sheet is the sum of total assets, which is basically equal to the sum of all the liabilities of that particular business. All the assets and liabilities are always equal. One second. Since businesses started to do the activities and to earn the profit, and to earn the any profit, amount invested in the business still 5 lakhs. In case profits are earned, increase invested amount in the business. For example, business suffers any loss, decrease invest. Okay, for example, what happens? Suppose we have got in our business, there are two items, that is assets and the liabilities. We have got the assets and the liabilities. Okay, next. In assets, we had a cash worth of rupees 10 lakhs, which I gave you an example. And liabilities, we had a capital worth of rupees how much? 10 lakhs only. Again, 10 lakhs. Okay. We had these of the two items in our balance sheet, in our business, which says that accounting equation will be equal only. Okay. Now, the thing is, we have a cash of 10 lakhs, we have a capital of 10 lakhs. Suppose we purchase stock. Now, what is the meaning of stock? Suppose we are purchasing goods. Now, what is the meaning of goods? The goods in which we deal. We purchase the goods, we add the profit, we sell the goods. Okay. Suppose we have a showroom. We have cash worth of 10 lakhs and we have purchased the stock, the goods of rupees 3 lakhs. Okay. Just imagine. Now, since we have purchased this stock of 3 lakhs, obviously we would have paid the cash. So the cash which will remain how much? Only 7 lakhs. Because out of the 10 lakhs cash, we spent how much? 3 lakhs for purchasing the stock, that is the goods. Now what happens is, suppose we sold these goods for rupees 3,50,000. Obviously, we are here to do the business. We are here to make the profit out of the amount invested in the business. Now what will happen? Just see that. Suppose we are selling this stock of rupees 3 lakhs for rupees 3,50,000. Just imagine each and everything. Now what will happen? The goods you had worth of 3 lakhs will go to the customer. So the goods you will remain will be how much? 0. You will be left with no stock, because all the goods have been sold to the customer. For how much? 3,50,000. That doesn't mean you have sold the goods of 3,50,000. It is you have sold the goods of 3 lakhs for 3,50,000. Just listen to the words properly. I have sold the goods costing 3 lakhs. The cost price of the goods was how much? 3 lakhs. These only goods have been sold to the customer for 3,50,000. So what is the amount I have gained from that customer? I have received rupees 3,50,000. I have not received 50,000. I have received 3,50,000 out of the goods of 3 lakhs. So what is the actual cash inflow? I have received the cash of 3,50,000. So my cash will become 10 lakhs 50,000. Okay. Now the question arises, this is not getting tallied. Obviously, it is not getting tallied. Now just tell me one thing. Why did the owner start the business. He simply started the business to earn profits. Now, business is an artificial person. Okay. So, whatever the amount a business earns is of whom? Is of the owner itself. So, owner started the business just to earn the profits. So now, since the business has done the transaction, business has earned the profit, so this profit is again liable by the business to the owner. So this is the amount which a business owes to the owner. This amount will be given to the owner. So what the owner just says that stop. You have got 10 lakhs which I had given you to start the business. So that is a liability. And again, a new liability has appeared of 50,000. The profit, that is also the amount which you as a business owe to me, that is to the owner. So just do one thing, just combine these both the liabilities and add this profit to my capital. I repeat once again, business owner started the business. The main purpose of starting the business was to earn profits. Now, to earn the profit, business got a cash of 10 lakhs, with which it purchased goods, the stock of worth rupees 3 lakhs. So, what is the remaining cash? 7 lakhs is the remaining cash available with the business. Now, what will happen? The goods have been sold to the customer for how much? 3,50,000. Since these goods are sold to the customers for 3,50,000, so what is the actual cash which a business has received? 3,50,000. So 7 lakhs plus 3,50,000, the total cash in hand will be 10,50,000. Okay. Since the cash is 10,50,000, so this is not matching. So this 50,000 is a profit. Why and how come it is a profit? Because we are selling goods worth of rupees 3 lakhs to the customer for rupees 3,50,000. So what does that mean? We have earned a profit of how much? 50,000 as a whole. Now business, since it is an artificial person, business doesn't have the family. So obviously, who is the owner of that business? Who owns that business? The owner owns that business. Is that clear? Now the owner, this amount of 50,000 which a business has earned is due to the amount given by the owner. So this profit is of whom? Of owner itself. So the business is liable to pay back this amount to whom? To the owner. So now earlier there had been a liability of 10 lakhs. Again, a business is again liable to pay how much? 50,000 more. So in total, the liability has become how much? 10 lakhs plus 50,000. So now the owner says, just do one thing. Since you owe me 10 lakhs, just add this profit to my capital only. So in total, the amount which you will owe to me will be 10,50,000. So what happens? This capital will become now 10 lakhs 50,000. The profits or the losses are to be added or subtracted in the capital itself. I just repeat, all the profits are added up in the capital and all the losses are deducted from the capital itself. Okay, so it has been written, if the profits are earned, it increases the invested amount in business. Obviously, the invested amount was earlier was how much? It was 10 lakhs. Now it has increased from 10 lakhs to how much? 10 lakh 50,000. So there is an increase of 50,000 due to the profits. So it has been written, the profits are earned will increase the invested amount. And the business, if business suffers any losses, just take another example. Let's see now. Suppose now what happened? We sold these goods. We had, okay, this was the actual thing. Now we purchased stock of worth how much? 3 lakhs. Now the remaining cash which is left with us, which is how much? 7 lakhs. Now what's happening? We sold these goods of 3 lakhs to the customer for 2,70,000. We have sold these goods to the customer for how much? 2,70,000 in a loss. So we will remain with zero stock, and the obviously we have sold the goods, we have incurred loss, but then also the cash is coming in. Obviously we have given the goods, we will receive the cash, not full 3 lakhs but 2,70,000. So we are receiving a cash of how much? 2,70,000. Since we are receiving the cash of 2,70,000, so in total our cash will become how much? We had a cash of 7 lakhs with us, plus 270, we will have a cash of 9,70,000. Again, these both are not matching. So now again, since the business has suffered a loss, so the amount invested by the owner has reduced. So this is the amount which will be deducted from the capital. So this will, after deducting 30,000 as a loss, after deducting 30,000 as a loss. How come 30,000 as a loss? Because we sold the goods worth of rupees 3 lakhs for how much? 270. Since we are selling the goods of 3 lakhs for 2,70,000, we are incurring a loss of how much? 30,000. So this 30,000 will be deducted from the capital. So it is written, if the business suffers any losses, if the business is suffering any of the losses, this will decrease the invested amount in the business. So it has reduced the amount invested in the business. Okay. I hope this is very much clear to you that all the profits are added up in the capital and all the liabilities are deducted, or sorry, all the losses are deducted from the capital itself. Okay. I hope this much is clear. Now we will see this. This is a format of balance sheet. This is a format of balance sheet. I hope this is very much clear to you. Okay. So in the balance sheet, we have capital. In the balance sheet, we have capital. Okay. We have capital worth of rupees 5,10,000 and outsiders liability, that is the creditors. Now who are creditors? Creditors are the person from whom we purchase the goods on credit. Okay, we have the balance of cash, bank, debtors, stock, furniture, plant and machinery. These are all the assets which are to be recorded in the asset side of the balance sheet. Okay, so now just see one more important thing. Here you can see as at. As at simply means on that particular date. That simply means as at, suppose if I say 31st March 2017 is the date. So as on that date, the balance sheet, the assets are these much and the liabilities are these much. Okay. I hope this is very much clear to you. Okay. So next is the example. So this ends our explanation for the accounting equation as a whole. I hope this full topic of accounting equation is very much clear to you. Thank you so much.